Stefan, have you had to alter your funding strategy to cope with increased needs as a result of the coronavirus pandemic and change the sort of tenors and instruments you use?
Yeah, actually, we expect our overall borrowing needs to be in a fairly unchanged range of 11 to 12 billion euros. We will see some additional demand for liquidity assistance loans from the agricultural sector and from the rural areas. At the same point in time, certainly the investment sentiment has been negatively affected by the SARS-CoV-2 crisis. So that should pretty much be volume neutral for us. We certainly had to react to the overall supply shock that we saw in March, going on from there, and that has triggered a significant widening of credit spreads in March. I would put that at roughly 20 basis points, pretty much across the curve. And our expectation was that the general spread levels, but also the steep new issue premia would come back once the dust has settled somewhat, and also once the ECB countermeasures would fully kick in, i.e. the PEPP on top of the already existing PSPP. And we were reasonably well funded at that time, and hence we decided to stay away from the benchmark market and focus on smaller transactions instead for a while. I guess the return of the US dollar as an attractive funding currency is also worth mentioning. It is set to probably even be, the US dollar as a funding currency is set to be even the largest issuing currency in 2020 after 3 years of unusually low share of our total borrowing. So for the last 3 years, the euro has accounted for more than 50% of our overall borrowings, and per year end, probably the US dollar is going to be back to more normal levels of 45 to 50% of our overall borrowing. At least right now, it looks to be fairly attractive at a reasonably stable level. The more borrowers you have looking for good opportunities to place large transactions, the more difficult it certainly becomes to get a good issuing window. So timing has been a constant challenge, though, but for the first couple of weeks, we figured that in particular in cross-currency funding markets, where we also a reasonably attractive cross-currency basis swap to take proceeds back into euros whenever there is a window of opportunity, more than one borrower is willing to jump at it, and certainly can have a negative impact on your all-in funding costs. So that's also something to watch, but it's more or less a theme we already have observed in 2019.
And with the change in the spreads that on offer and the yields, has the investor base that looks at your assets changed?
Actually, it looks year to date, it looks pretty similar in terms of investor type. We have placed 50% of our issuance with bank treasuries, so the typical LCR portfolios, around a third with central banks and other official institutions, and 12% with asset managers, and a fairly low share of 3% with life insurance companies, pension funds, and the likes. But then we have a lot in 10-year space or in maturities beyond 10 years. So that's normally the part of the curve which attracts lifers and pension funds. In terms of redistribution, that has been very healthy with a global take. Certainly the strongest share has been coming from the UK, Germany, and other European countries. We've seen some interesting demand from Eastern European central banks for euros, probably due to the widening of spreads of our bonds versus bunds. So they certainly know that Rentenbank has a full guarantee in place, and that our debt basically ranks pari passu with all claims on the Republic of Germany. So whenever spreads trend wider, that's certainly an attractive opportunity for them to buy the German sovereign credit with a reasonable credit spread top up. So that's a bit of a change we've seen, but apart from that, things have been business as usual.